Hi everyone and welcome back to a brand new episode. My name is Marcus and I'll be your host. In today's episode we're going to take a look at Netflix. If you're new to this channel, welcome. What we do here is that we study and analyze stocks. We go through the fundamentals and the technical analysis of a stock, but we also talk about finance and investing. And if you've been here before, thank you so much for coming back. I truly hope you guys will enjoy this episode, and please give me a thumbs up, comment, subscribe. Let me know in the comment box below what you think, but also what stocks you want me to take a look at. Thank you. Now, let's get started. As I mentioned, we're going to take a look at Netflix, and if we go down to the screen, we can see here that they are traded on Nasdaq, and they are in the trade and service sector, and their market capitalization is at $258 billion, and their revenue is at $27.6 billion. Now, their PE ratio is at 60. Normally, I like to take a look at companies with a PE ratio of 20 or below. So having a PE ratio of 60 is too high, but that also indicates that the market expectation of the company is high. And there is an overhanging risk that if the company doesn't meet those expectations, we will see the stock price fall. So having a PE ratio of 60, that is a no for me. And their market profit margin is at 15%. I like it. Normally, I like to take companies with a profit margin of 15% or higher. So having a 15.9%, that is on the threshold, but they get a pass. So that is a good to go. I like that. Their price to sales ratio is at 9. Normally, I like to take a look at company with a price to sales ratio of maximum 2. So having a 9 is too high. So that is a no for me. Price to book value is at 18. That is too high in my eyes. I like to take a look at companies with a price to book value of maximum 3. So having 18, that is just too high. So that is a no for me. So if we summarize, the PE ratio is too high, the price to sales ratio is too high, and the price to book value is too high, and that indicates that the company is overvalued, and the stock price needs to fall in order for the stock to become more attractive. Now, they don't pay out any dividend, which is a shame. It's a bummer. I like those dividend income. And the return on equity is at 37.9%. I like it. The return on equity basically tells you as an investor about the company's ability to create a return on the invested equity. So as for an investor, especially for a stock that doesn't pay out any dividends, it's critical to take a look at the return on equity and see if the company is able to create a return on the capital that you invest in them. So having a 37%, I like it. So that is a go for me. Now the return on assets is 9.7%. I like it. A bit low number, but it's still positive. I like it. So they get a pass. I like the return on assets. So that is a good to go. They're currently traded at $579 per share. And if we take a look at the 50-day moving average, we are trading above it, but also way above the 200-day moving average. This is a clear signal that we might see the stock price go even higher. And we can tell if we glance just quickly on the chart is that we have been consolidating over quite some time. The price broke high, so this could be a false breakout. We just need to be patient and watch it carefully, because we might see price go down to the support level, and if the buyers come back and push the price even higher, and if it goes above this level, then that's a buy signal. But otherwise, we just need to be very cautious here, because this could be a false breakout, and we might see the price go down back to the channel. But we'll take a look at the technical analysis further down. But let's move on to the income statement. And what we can tell here is that the total revenue went from $8.8 billion in 2016 up to $25 billion in 2020, and it has been growing steadily every year since that. I like it, so that is a plus. The gross profit went from $2.8 billion up to $9.7 billion, and it also has been growing steadily every year. I like it. Now, the net income went from $186 million up to $2.8 billion, and it has been growing steadily every year. That is a plus. I'm liking what I'm seeing right here. So now let's go over to the balance sheet. And what we are interested here is that the current assets versus the current liabilities. And we can tell that the current assets is greater than the current liabilities, which is a plus. Basically, it means that if the company were to convert current assets to cash, they're able to pay off their current liabilities. So that is a plus. But they're not able to pay off their total liability, which is a shame. So that is a minus. And if we take a look at the total liabilities, it went from $10.9 billion up to $28.2 billion. It has been growing steadily every year, so that is a minus. I would like to see the company reduce their total liabilities. And if we take a look at the outstanding shares, we went from 430 million outstanding shares up to 442 million shares, outstanding shares, and has been growing steadily every year, so that is a minus. Basically, what it tells you as an investor, if you see a company increase their outstanding shares, that means that your share of the company is decreasing. So it's a way for a company to bring in more capital. Instead of taking out more loans, what they do is they bring out more shares and bring on capital. And there's a lot of investors that miss this one, because they've been looking at the total liabilities. And there is a company, for instance, they will see that the total liability is not growing that much. And they'd be like, okay, this looks good. The balance sheet looks good. But the number of outstanding shares has been growing rapidly year by year. So your share of the pot is decreasing. So seeing that they're increasing the outstanding shares, that is a minus. Now let's move over to the cash flow, and what we are interested here is that the operating cash flow, and we went from negative 1.5 billion, and the performance got worse every year, and then we went plus 2.4 billion dollars. Well, this had a negative trend, and we can see that it's just at 2020 that we went positive, that we are a difference of $2 billion between the operating cash flow and the capital expenditure. That's what we want to take a look at. The difference between the operating cash flow and the capital expenditure. So having a negative number here is a minus. Now let's move over to the key figures. And what we can tell here is that the earnings per share went from 48 cents to $6.2 per share, and has been improving every year. I like it. Revenue per share went from $20 up to $56 per share, and has been growing steadily every year. I like it. And the equity per share went from $6 up to $24, and also has been growing steadily every year. I like that. So no dividend, which is a shame, but just by looking at what we saw on the cash flow, they shouldn't be paying out any dividends. But I like the dividends, but so they don't pay out any dividends, and they shouldn't pay their dividends, any dividends. So that is a minus. Now profitability, the gross margin went from 31% up to 38%, and has been improving every year, which is a plus. But we also need to be cautious here, because having a gross margin of 38%, that means more than 60% of your sales goes to the cost of goods sold. Imagine selling a product or service for $1, and you get to keep 38%, and you still have your operating costs that you haven't paid for yet. So that is just too low. So they need to become more and more, look for ways to become more and more efficient, because having a cost of goods sold of more than 60%, that is just too high. Operating margin went from 2.9% up to 12.8% and has been growing steadily every year. I like it. But they need to reduce their operating costs and reduce their cost of goods sold. And their profit margin went from 2% up to 11% and has been growing steadily every year. This is a minor plus. I like it, but still, I want to see a company with a profit margin of 15% or higher. They get a plus because they have been improving the profit margin every year, so that is a minor plus. The return on equity went from 6% up to 24.9% and has been growing steadily every year. I like it. Basically, as I mentioned before, return on equity is a way for us investors to see a company's ability to create return on the invested capital, especially when a company doesn't pay out any dividends. We need to see that they are able to return, provide a return on the capital that we invest in them. Now, the return on assets went from $1.3% up to 7%. And has been improving every year. I like it. Solidity went from 19.7% up to 28% and has been improving every year. I like it. Basically, what solidity looks at how much of the total assets is financed by the equity, and it also gives us an indication of about the company's financial strength for the short term, and seeing that they are improving, that is a plus. I like it. The balance sheet went from 1.6 down to 0.49 and has been falling every year. That is a minus. Balance sheet liquidity is the same thing as solidity, but here it looks at the company's financial strength for the long term, and seeing that their financial strength is decreasing, that is a minus. They need to find ways to improve it. Debt ratio went from 4 down to 2.5 and has been falling every year. I like it, so that is a plus. Basically, what it tells you is that by 2020 they had 2.5 times more debt than equity, but their number is falling every year, so that is a plus. I like it. So we have gone through the income statement, the balance sheet, the cash flow, the key figures, and now over to the most important part of our software, and that is the pillars. Basically, what the pillar does is it gives you an easy summary, easy way to digest an overview of the company's performance in just one slide. So it saves you a lot of time. And if you want to dig through the numbers, you can dig through the numbers. And if you want to have a quick glance of the performance, the pillars is the tool for you. For example, if we summarize, we can tell that the PE ratio is above 20, which is a negative. They don't pay out any dividends, which is a shame, but they shouldn't, by looking at their statement, their balance sheet and cash flow, they shouldn't be paying out any dividends. And their number of outstanding shares have been increasing, that is a minus. The revenue increased over the past 5 years, that is a plus. Profit margin above 15%, that is a plus. Profit increased over the past 5 years, that is a plus. Current assets greater than current liabilities, that is a plus. Solidity increased over the past 5 years, that is a plus. Balance sheet liquidity decreased over the past year, that is a minus. And debt equity ratio decreased over the past 5 years, that is a minus. And the total liabilities have increased over the past 5 years, that is a minus. Guys, as you can tell, it gives you an easy to just digest summary of the company's performance in just one slide, one picture. What we have gone through, it gives you right here. You can have this software for only $25 per month, and also with everything we've gone through, but you also get our analysis page where we publish articles and videos for you to enjoy, but you also get to be able to chat with me alongside other members. So jump on today. It's only for $25 per month, and it's yours to have. Now let's jump over to the technical analysis of the stock. So here we have the technical analysis of Netflix. So let me take just a quick glance here and lay down the support line. We have a support line, something like that. Let me change the color to green. And we can tell that we are trading higher and higher. But we also, if we take a look at this area, as we saw previously, is that we are currently consolidating right here. You can tell that here's the support line, and here we have the resistance line here. And let's change that color to red. And as you can tell, we are consolidating right here, and this area right here could be a false breakout. Guys, you need to be very cautious here. I would be very cautious here because, let me see here. Okay, let me see. Okay, so because right now we are trading lower and lower number, and we are currently at the support line. So if we see a lot of buyers come back and push the price higher, then if we break above this area, then this signals that there is a buy here. But what I would be doing is I would wait for the price to push higher, and if we push higher than the previous high, then that's a signal that there is a buy. But my gut tells me that we will see the price go down back to the channel and down to these levels right here, and if we touch the support line, then that is a buy, and you'll be able to do at least, yeah, you could do a 20% price move. It's not a huge number, but it's still a good trade. So that's what I would do when to trade a consolidation like this. The dream scenario would be if the price went down to this area, then that would be a great buy. And if we would buy right here, let me see here, we would see a price move of 40%. Now that's a trade to look forward to. But even though the price is trading above the 250-day moving average, a signal that we might see the price move even higher. So we need to be cautious here. So if the indicator is correct, then we might see price move even higher, and if it breaks above the previous high, then that's a way to buy it. But I would be very cautious and wait and see if the price breaks down back to the channel, and that would be a signal for me that we will see the price move up back again when the price moves down to the support levels, and that's where I would trade, enter the trade. Now, how would you trade the stock? Please let me know in the comment box below. And guys, this is it for this episode. I truly hope you have enjoyed. Please give me a thumbs up, comment, subscribe, and let me know in the comment box below how you would trade the stock, and also what you thought about this video, and also what stocks you want me to take a look at. Until next time, guys, take care. Bye bye.